Hi guys, so I recently ran a poll for my subscribers to find out what type of content you most wanted to see from me. And the result was that you most wanted to know how to achieve FIRE tax efficiently. Now that's music to my ears because it's what I've spent much of the last 16 years helping people do. And it's what I get the biggest buzz out of. So you've spoken and I've listened. That's exactly what I'm going to be discussing in today's video. It was a closely run thing though, so if you voted for something else, don't worry, I've looked at all the results and I will be using them to create the most valuable content that I can for you. So guys, if we haven't met before, I'm Bourne. I'm a financial planner based here in the UK and I help people achieve financial independence early, tax efficiently. I do that through advising people on the most efficient use of tax allowances, wrappers and reliefs, and this channel is my place to share some of that knowledge with you. So if that type of content sounds like a bit of you, why not subscribe to the channel? And with that said, let's get into today's video. Financial independence retired early. FIRE. It sounds like something that might only exist in your wildest dreams, a mythical creature almost that's out of reach for the majority of people. From my experience though, that's not the case. And I found that once people have been able to gain clarity on what they need, the rest is simply a numbers game. It's a case of managing probabilities and risks. Knowing what you need though is where most people struggle. How do you actually know what amount of income you're going to need to retire comfortably 20 years from now? What will you be doing? What will things cost? How can you plot those variables into a cogent plan? The simple answer is you can't. All you can do is make assumptions on those things and take positive action. I've found from lots of experience of managing people's financial situations that once you let go of trying to control the outcome of everything and you just take positive action, you end up 1,000 miles ahead of everybody else because they're still stuck at the starting blocks. I can count on one hand the number of people I've met who know exactly what they want to do in 10 or 20 years time and how much it will cost them. So if you don't know yourself, don't worry. Don't get hung up on the minute detail. You can focus on detail further down the line. Initially, it's good enough to just say, I don't know what I want. But I do know what I don't want. I don't want less than what I've got now. That's a great starting point. For most people, being able to earn their existing level of income, which is providing their existing lifestyle, without having to devote a large portion of their time to generate that income, to instead being able to devote that time to other passions and interests, would allow a very fulfilling lifestyle. So I always say, unless you have a more specific goal, let's make that your target. It's your net income figure you'd be aiming for, of course, because that's what you actually live on. If you're employed and earn £40,000 gross, for example, your net pay in 2021-22, assuming a standard personal allowance and a standard pension contribution, is going to be approximately £29,000. And it may be possible to achieve that net figure in future without any tax deducted, or certainly very little, by using tax wrappers and allowances. I'll elaborate on that a little more later, but suffice it to say that the annual net income figure is your target. You'd then have to build in an inflation assumption, of course. We don't know how much things are going to cost in future, but we do know that it will be more than they cost now. The Bank of England's inflation target is 2% a year, so that's as good an assumption as any. Now, a nifty little trick to work out how this will change your target is to enter this simple formula into a calculator. It has to be an actual calculator though, it doesn't seem to work on phone calculators. For a 2% compounded increase, type in 1.02 multiplied by the starting figure, so let's use £29,000 as an example, then equals for however many years into the future you want to look. So 10 years would be 10 presses of the equals button. We know therefore that if you want an income in 20 years time with the same buying power as £29,000 today, assuming 2% annual inflation, you'd be targeting £43,000. Okay, great, so you know what income you're targeting. Now what? Well, you then need to know how much capital would be required to generate that kind of income. And once again, this requires you to make some assumptions. And it's at this point that one of the most well-known FIRE principles usually comes into play, the famous 4% rule. I'm sure many of you already know what this is, but briefly for the unversed, it's basically an assumption that 4% is a safe annual rate of withdrawal from your investments, allowing for inflation, where you'd be unlikely to run out of capital over the long term. Now there's some debate about when the 4% rule was first theorised, but it was popularised by something called the Trinity Study, which was carried out by a team of professors at Trinity University in Texas in 1998. The study has been updated since, and the findings have generally been corroborated, although there's probably more a leaning towards 3% being a safer rate of withdrawal, particularly if you're looking at very long withdrawal periods of say 40 or 50 years, because the original study just focused on 30-year withdrawal periods. Now, this principle has its supporters and it has its critics. It's not perfect, and there are flaws to it. I must admit that as a financial planner myself, it doesn't even figure into my equations when I'm testing the sustainability of withdrawals for my clients, because I use advanced cash flow modelling software to do that. Hardly anybody sticks to a fixed level of withdrawal for their entire retirement. Sometimes my clients take much more than 4% withdrawals for certain periods of time. Then they might take less for other periods. The main thing is managing cash within their investment wrappers to reduce the sequence of returns risk. But that's for another video. So make sure you subscribe to not miss that, and if any of this has been helpful so far, please drop a little thumbs up below. Everything differs from person to person because all circumstances are different. People want to retire at different times. Some people have additional income sources like rental income. Some have company pensions that start at different times throughout retirement. There are different levels of state pension paid. Expenses might start high and then drop, especially when the mortgage is repaid or the kids have finished uni. I say all this just to illustrate that a financial plan is an evolving thing. So as a basis for creating a target that's quite a long way into the future, using the 4% rule is fine as a starting point. Now, to work out how to do that, all you simply need to do is multiply your target income figure you've arrived at by 25. So if your net income is £29,000 and that's your base target, but you know that your mortgage, which is costing you £6,000 a year, will be gone, and instead of paying £4,000 a year for your car, you'd be happy to get one for £2,000 a year, your unadjusted target would be £21,000. Let's say you're 30 now and you want to knock it all on the head at 50. So applying that 2% annual inflation increase over 20 years means you're aiming for £31,200. 25 times £31,200 means your capital target is £780,000. Because 4% of £780,000 is £31,200 a year. And you should be able to build inflation increases into that. To build that amount of capital over a 20-year period from a standing start, with a 7% estimated annual growth rate on your investments, all you need to do is save £1,537 a month. Easy, right? Well, on the basis that you'd only be earning about £2,400 net, this would be over 60% of your income. So that level of monthly investment would be unrealistic. But instead of stopping there, which is what most people do, there are a number of things that you can do. The first one would be to ask yourself, do you want to completely cease work at that time? Or would a partial retirement be something you could get on board with? Remember, this is all about planning ahead and designing a lifestyle that you're happy with. Perhaps the freedom to work a 3-day week instead of a 5-day week at 50 would be something that you'd like to target instead of total retirement. That could be 3 days a week doing what you are now potentially, or something completely different, and you might be quite happy with that until you finish completely, perhaps at the state pension age. If you were to assume though that 3 days work a week could bring in £1,000 a month in today's terms, inflation adjusting that in the same way as before would actually reduce your target by £17,800 to just £13,400. 13,400 times 25 is £335,000. And growing that amount of capital over 20 years on the same basis as before would require a contribution of just £661 a month. That's obviously a much more manageable target. But if we also assume that part of that monthly contribution was placed into a pension, the net cost to you would be even lower thanks to the magic of tax relief. You couldn't solely use a pension if your plan was to start accessing capital at 50, because you wouldn't be able to touch the pension until at least 57 under the current rules. But if you were to split the contributions half and half between an ISA and a pension, with say £330 a month into each, the pension portion would cost you only £264, because £66 would be added by HMRC as tax relief. Your total out-of-pocket expense, therefore, would be about £594 a month. And that doesn't account for any additional tax relief that you might get if you became a higher rate taxpayer. The other thing within your control, of course, is that you can earn more money. There are so many ways you can do that these days without even having to leave the house. And YouTube is probably the place to start for inspiration. Even if you earned an extra £250 a month net, that paid into a pension would be grossed up to £312.50. And over 20 years at 7% compound, it would add another £160,000 to your total. Now that might mean you can drop down to 2 days a week, or you can pay yourself a bit more. The world really is your oyster, but the time to start is now. The cost of delaying that £661 contribution by just 1 year would be about £25,000, thanks to the power of compound interest. So don't put off to tomorrow what you can do today. Like I said, growth rates will be different. Inflation rates will be different. Your circumstances will change. So don't try and second guess things. Just take action now and you'll be rewarded for it. One thing that will make a big difference to your future income position is tax and how you plan for that now. We're quite lucky in the UK that we've got generous annual contribution allowances for tax wrappers like ISAs and pensions. Between those two wrappers, you could be paying in up to £60,000 a year with some significant tax advantages. The combination of being able to draw benefits completely tax-free from ISAs, with the upfront tax relief and ability to flexibly take tax-free cash from pensions, is enough to cover the vast majority of people's needs and produce quite a high tax-efficient income. As a rule of thumb, if you're aiming for a very early retirement, anything sort of 50 and below, the balance of your contributions needs to be more in favour of ISAs and perhaps other types of investment vehicles rather than pensions. You shouldn't exclude pensions completely though, because the tax relief benefits make them very attractive. And as I've already mentioned, planning your future income is done in stages. You don't need all wrappers available at once. Most of my clients come to me at a more advanced stage of planning. When their pensions are maxed out, for example, and they want to know how they can still gain tax relief and tax efficient income. When they've got capital gains tax liabilities that they'd like to freeze and roll over to a future year when their rates might be lower. Even if they want to reduce their inheritance tax liability, but still receive a tax efficient income from their capital. What you're doing by planning now is simply buying choice. More capital means more choice and more freedom. So just getting started investing whatever you can afford, even if it's not the full target amount yet, is better than taking no action at all.